I guess everybody wants to know, Chamath, you've wound down 2 SPACs. Thank you for doing this for IPOF specifically, because people are replying to me every day asking, what are you going to SPAC? But IPO D and F, the money has been returned to investors.
No, it's going to be returned.
Going to be returned to investors, thank you. And Bill Ackman, of course, he wound down his SPAC, returning $4 billion. There's over 500 SPACs out there looking for deals. Tell us why this decision.
Look, I've raised 10 SPACs, six in technology and 4 in biotechnology. And I've done 6 deals, 2 in tech and 2 in biotech.
4 in tech.
Sorry, 4 in tech. 4 in tech, thank you, and 2 in biotech. So the reason to shut it down is pretty straightforward. It's like, when we launched these things, the stock market was in a much different place than it is today. And so over the last 2 years at looking at deals, it's gotten harder and harder to find a good risk reward. Now, why is that? Well, the thing with the SPAC is you do a deal today, but it doesn't usually close for 6 or 7 months in the future. And so you have to do a deal where you have a really good sense that in 6 or 7 months, when the deal comes to close, that the price will be the same or even higher than what it is today. And if it isn't, all of the investors that you've brought along in the SPAC have a right to redeem, which is to say they file a notice that says, you can complete the deal, but I want my money back. And what they get back is the initial $10 that they used to buy the stock in the first place. Because when we started the SPAC, we sold stock at $10. And so from my perspective, I was looking at this and I'm like, this is a super volatile, ugly point in the market. This last year has been really problematic. I kind of said this last November, and Nick, we can play the clip after and we can come back to it. But basically my decision was that at this point to do a deal would probably, put a lot of capital at risk. And in all of these deals, I'm typically investing $100 million at least in each of them. And so I couldn't justify that. I couldn't see a good risk reward. And I thought the right thing to do, the responsible thing to do was just to wind these things down. I'll lose, 10, 15, 20 million bucks for having set these things up. But we give everybody their money back, that $10. And I think that's actually better over the next 5 or 6 months than what it'll otherwise do if you're invested in the market. Now, that's a belief that I have. But hopefully when people get the $10 back in the next few weeks, if they want, they can go and put that money back in the market. And hopefully they'll do well. But, from my perspective, the risk reward was not good.
Is part of the issue the inventory that's available of great companies as well? That's one of the things I heard speculated on CNBC. It's hard to convince a private company to go public.
Here's my experience. When I was talking to all of these CEOs of these Silicon Valley companies, initially there was a lot of misunderstanding about what SPACs were. And I think we were able to dispel that because we had some really successful transactions. Then there was a lot of interest in being a part of it. In this phase, we were suffering from 2 very important things. One was that valuations were just completely up in the air. People had a huge question mark on late stage valuations because we would come in, we would do the work, and we would say the company is worth X. And that number typically was 50 or 60% lower than their last private valuation. And so when it came time for us to negotiate, doing the deal, even if the founder was roughly on board, the rest of the board was not. Because a lot of them would have seen some pretty meaningful markdowns in their private assets. And when the company had enough money to kind of at least stay private for another year or so without having to raise money, on balance, those investors felt it was more prudent for them to not take the mark and to not take the deal at such a lower discount. So that was a big issue that we ran into because every time we would price a deal, again, we're trying to create a margin of safety for us and our investors, again, because it's going to take 6 to 9 months to close a deal. And so ideally
so
you want this
thing. A lot of valuation indigestion.
And then, the second thing was just volatility. So when you see volatility in the public markets, for a CEO, and I can understand this, it's much easier to go public in a point where the markets are generally going in one direction because it gives them the confidence to be able to learn the ropes because it is a complicated process being public. And when you introduce tremendous market-based volatility independent of your company, I think a lot of CEOs and CFOs and IR people were a little nervous.
Why take the risk?
And that was the second piece. But by and away, the first one was valuation. We could not find market clearing prices.
Makes sense.
For assets. And by the way, and I'll talk about one company in specific, which just this week had a pretty public blow up around this whole issue. And look, I've been pretty clear about this since November. The marginal trade should have been to be trimming risk. And Nick, maybe you can play the clip because I really want to make sure that it's very clear and on the record what I said almost an entire year ago.
Let me put crypto in the context of the markets and where we are today at the end of the week after, Q3 earnings in November of 2021. We have the stock market at absolute all-time highs.
Ripping.
We have crypto at absolute all-time highs.
Ripping.
We have the art markets. I don't know if you guys saw Phillips and Christie's and Sotheby's this past week at absolute all-time highs.
Sold another Beeple for $25 million.
We have inflation at a 30-year high. We have 10-year break-evens at a 25-year high. We have, 1 point some odd trillion dollars that we just approved last week, and we're still horse trading on another $1.8 trillion of stimulus that we're going to put in. And I think the most important thing, which is the two most important founders of our generation, the two smartest people who have really consistently won, Elon Musk and Jeff Bezos, have collectively sold more than $11 billion of their holdings this year alone. And if you can't take all of that and decide for yourself what's right for you and your family, you're doing yourself a disservice. I think it's important for me to never sort of be forced to tell folks whether I'm buying or selling, although I'm willing to do it in moments where I think it's important. But I think it's really important to understand the context. And so I think these folks that think derisively about individuals who are managing risk, I think it's really naive. And I think it creates a lot of missed opportunity for them as well. If the smartest people in the world are now selling their core holdings that they told you they would never sell, and you are not reconsidering your position on things, you're either much smarter than them or you're being really, really reckless.
The reason I said all of those things was because I was getting really worried about where we were. And then I think on the heels of that, I published a tweet and I said, I'm starting to sell. And I sold $100 million of SoFi, but then I was a systematic seller through the end of last year and through this year to try to manage my own liquidity because it changed profoundly as I saw what was happening in the markets. So, I think that it's just an important thing to call out that things don't always go up, and you have to pay attention to a mosaic of information, and you have to do the work yourself because your situation is unique to you. Nobody else understands it. And so you can't outsource that decision to somebody else. Obviously, you can use it as a guide. It's fair to say, when the 13 Fs of important hedge funds come out, do I read them? Of course, because I'm trying to figure out, what don't I know? What may I be missing? Maybe there's a great company in there that I should be taking a look at. So, I'm not dissimilar to everybody else in that I use other people that I look up to or respect as a leading indicator of what to buy. But I still take responsibility for my own decisions and I manage my liquidity as best as I can based on my conditions. And those are always changing. And so I think this is just a good reminder that everybody else has to do the same.
So Chamath, what do you think happens to the remaining 500? Every SPAC sponsor friend of mine that I know is not seeking targets anymore. They're all expecting to wind up and return capital. How many of the 500 do you think will actually find a target? And how many do you think of remaining SPACs, how many of them will wind up and return capital?
I think that there's still some really good deals to do. They're not necessarily in tech per se. So, I think you did a really great deal in ag tech. I think that's really interesting. So time will tell how that does. I think there's some really interesting deals in energy. In fact, we spent a lot of time actually pivoting and spending time in energy, looking at, everything from, producers of nat gas and oil to, folks that were building terminals to LNG facilities but it's just a very different return profile than what we were used to. So I think if you can understand some of these other markets and you can underwrite to a different rate of return, some decent deals will get done. The overwhelming majority of the tech SPACs, I think, probably will just wind up. Some folks will be really focused on trying to, monetize their founder promote. So they'll do any kind of deal. The problem, as you see, is even whether you do a good deal or bad deal, with the kind of volatility we're seeing in the market, the likelihood is that it's going to trade down pretty significantly. So I think most will not find a home. I think some will find some really interesting targets in areas like energy, I think are really interesting. Agriculture, like what you did, Freeberg, I think is a really interesting deal. And then, you know what? It'll be an opportunity for us to retool the SPAC. I don't think it's going to go away. I think that it is a useful tool in a toolbox of many tools. So there's IPOs, there's direct listings, there's SPACs, there's obviously private fundraising, there's convertible, there's structured deals. So it is a tool. And I think when used properly, it can be really helpful. You know, for the companies that we worked with, it would have been impossible for them to raise the quantums of capital that they did. Primary capital from sophisticated hedge funds and mutual funds. You know, we raised billions and billions of dollars for companies like SoFi and Open Door. And I think that that's going to go a long way for them to achieve their goals. So I think it's going to be a good tool, but we're going to go through a washout of most of these folks who are not going to be able to successfully find targets.
Sachs, when we look at private companies, especially the late stage ones, you and I are involved in a number of them. They're doing riffs, they've got headwinds, and their valuations are underwater in many cases. How are they thinking about the public market windows, SPACs, direct listings, or just a traditional IPO?
I don't know that they are thinking about it. I think like going public seems like a fantasy at this point. I think the whole public markets exit idea is frozen for 2 years.
2 years?
I think that's probably what people are thinking.
What are these late stage companies that raised mega rounds doing to work out valuation issues? Because as Chamath just pointed out, with SPACs, one of the problems was clearing market. The late stage investors who came in, maybe they, don't want to accept the haircut in valuation,
Probably
even if they have
enough.
productive.
Probably not enough. I mean, what they're doing is using their war chest to grow into their valuations, which is the smart strategy. And if they're really smart, they'll be slashing their burn while they do that. But yeah, it's no different than what we've talked about before. I think the main significance of this past week is that you had the Fed meeting. It raised another 75 basis points. There's no surprise to that. That was predicted. What was new was the forecast. They're now saying that they expect to raise another 1.5%. Just 2 months ago at the last meeting, they were saying 75 at this meeting plus 50 after that. Now they're saying 150 after this. So, in just 2 months, they're now revised their forecast for an extra 100 basis points of rate increases. Why? Because inflation is worse than they thought. So things are worse than we thought 2 months ago. The last inflation print didn't get better as fast as people wanted. We talked about that last week. Now the Fed is revising its forecast. The trajectory is bad and getting worse. And you finally had Powell kind of throw in the towel on his rhetoric around soft landing. I mean, first it was, well, we can raise rates and we won't have a recession. Then it was, we might have like a mild recession. Now he's basically saying hard landing if you read these FOMC comments. So I think this was a really bad week for the economy. And you're seeing it in the markets this week. I mean, we are retracing almost within 5% of the June lows, with the growth stocks being the ones that are hardest hit.
By the way, speaking of growth stocks, have you guys been following this trials and tribulations with Byju's, which is like one of the largest valued private companies, but it's a private Indian edtech company? Essentially, I think there was this delayed audit and Deloitte couldn't certify a bunch of things. And then finally, they were able to come up with a report that essentially showed instead of breaking even or making money, they lost almost $600 million this year. And that a lot of the revenue that they were booking were actually loans to millions of Indian families who had basically zero probability of paying them back. So a lot of the revenue was not real as well. And this is like a who's who of investors. It's everybody from, Sequoia, Tiger, UBS, BlackRock, Chan Zuckerberg. It's incredible.
I think when the tide goes out, we find out, right? And this is what's happening. The tide's out and you're going to find all the weakness in the system. It's all going to get flushed.
I think this is a bit of an outlier, obviously. I don't think that, all these companies that are worth tens of billions of dollars are running so close to the sun. But it just goes to show you that, how does how does this happen? Like how do you not get a data?
We saw this on the seed stage in Series A. We would ask for a data room. The person would say, "You're the only investor asking for it, and you're putting in, 10% of the round. These other people aren't even asking for it." We said, "Okay, can we still see the data room?" And it turned out there wasn't one. People were just making bets. They were making blind bets. They were betting without even looking at their cards or thinking about the other people's cards.
This goes back to what Friedberg was saying before. I think there's a sliver of the retail investor base that is not dissimilar to a sliver of the private equity and hedge fund and venture capital space, which is these folks are not willing to do the work. I think most people are, and most people want to come to their own conclusions, but some people want to just take the easy momentum-driven decision. And they typically always get punished.
Over time. There's this concept of adverse selection, which is that the negative actors will find them, will seek them out, and it will be a match. And so they'll ultimately get adversely selected into the deals that blow them up.
So the bad deals, what you're saying is the bad deals would find the bad investors who don't do the work, and then they spiral and crash together. That's a really brilliant observation. Yeah.
Yeah, I think the other.
That's what I'm here for.
I think the other thing is like you have this situation where if it wasn't that, it's folks outsourcing their diligence to the person that did the round before it.
Totally.
Silver Lake did it.
Same problem.
Tiger did it. Okay, these guys are very sophisticated investors. I don't need to do the work. It turned out you did because it was a very cavalier way of recognizing revenue.
There was a specific playbook here too that I don't know if you saw this, Sachs, in the early stage, where people would get their friends to invest in the company or some high net worth individuals, and then you look at the deal and the valuation didn't make sense, and then you say, well, we would always ask, how much money is each person putting in? And we're like, well, their normal bet size in the seed is $750 or $1.5 million. But they're putting $50K into this or $100K. What's going on here? And it was, they're friends with them. They worked at a previous company together. They went to the same college. And so people were using social proof, but manipulating it to get some other sucker at the table to pay full price and not due diligence. Really strange behavior.
I was in Singapore this week. There was I had this great meeting with this young investor, really dynamic guy, and he was telling me about a company in Indonesia that he didn't invest in. But it turned out that that this founder was literally running two parallel sets of accounting systems. And so he was, showing a business and fundraising from this set, but the real books were over here, and it looked a completely different system, and it was basically like a Ponzi scheme. And he was telling me it's like impossible to root these things out. So what he said he relies on is like you have to have a network when you're doing these frontier country deals where, he says, I need to find at least 10 people that know this person so that there is sort of like a moral social proof and moral diligence that happens because that person will never try to commit something that egregious in the face of all of their friends. And so, that's a mechanism of filtering this stuff out. But I thought that was a really interesting way of designing a diligence process, at least in a frontier market. Here, I don't think you have that much time to do these really, fast-paced deals. And the social proof matters less because you theoretically, are looking for signals of traction. But there has to be a better systematic way of getting this diligence done because these things should be pretty obvious.
Sachs,
before it's a multi-deca-billion-dollar company.
Sachs, last year when people were moving really fast, saying they don't have time for diligence, you're going to lose the deal, yada yada. How did you approach diligence during those peak periods? And did you have those experiences where people were trying to push you to close without talking to customers or looking at bank statements, yada yada?
No, we wouldn't play that game because we always run SaaS metrics. That's always the starting point for us. But most SaaS companies, they have SaaS metrics. I mean, it's so standardized that it would be such a red flag if they didn't.
Yeah.
I think it might be companies that are, have unusual business models, or maybe they would say something like that. But
Got it.
No, we could never do a SaaS investment without SaaS metrics.